The United States is grappling with a profound job crisis that has left millions of Americans facing economic uncertainty and hardship. This crisis has been exacerbated by a complex interplay of factors, including the COVID-19 pandemic, technological advancements, and shifting economic dynamics. Technological advancements have also played a pivotal role in reshaping the labor landscape. Blame it on automation and artificial intelligence having led to affecting certain jobs, particularly in industries such as manufacturing and retail, further exacerbating the job crisis. The U.S. workforce added 336,000 jobs last month, much more than expected, as the world's largest economy remained resilient in the face of higher interest rates. The sharp acceleration in hiring saw non-farm payrolls rise during September by almost double the rate anticipated by economists. Readings for July and August were also revised higher, with 236,000 and 227,000 jobs added, respectively. Employment growth had been fading in recent months, according to official data, but remained largely resilient while the Federal Reserve battled to get inflation under control. This bolstered hopes that the central bank will manage to guide the economy to the soft landing where price growth normalizes and recession is avoided. Leisure, hospitality, and social assistance areas continue to have the biggest job gains, as well as government, healthcare, professional, scientific, and technical services roles. Earlier this week, ADP reported private payrolls were up just 89,000 in September, sharply down from 180,000 in August and far below estimates of 160,000. However, markets were shaken a day earlier after the Labor Department released data showing an unexpected increase in job openings in August after the metric fell for 3 straight months. This is the second consecutive month job reports have surpassed expectations. The increased interest in job numbers comes as the Federal Reserve has warned that rates of interest will remain elevated over the next 2 years, despite a pause on further hikes, in a bid to cool inflation. A slowdown in the jobs market is expected to help calm inflation, which continues to remain well above the Fed's target of 2%. Friday's report from the Labor Department showed that hiring last month jumped from a 227,000 increase in August, which was revised sharply higher. July's hiring was also healthier than initially estimated. The economy has now added a healthy average of 266,000 jobs a month in the past 3 months. The unemployment rate was unchanged at 3.8%. The job market has faced so many threats, notably owing to high inflation and the rapid series of interest rate hikes that were intended to conquer it. Though the Fed's hikes have made loans much costlier, steady job growth has helped fuel consumer spending and kept the economy growing. Surveys by the ISM, a trade group of purchasing managers, found that both manufacturing and services companies kept adding jobs last month. Among banks, restaurants, retailers, and other service sector companies, hiring accelerated in September compared with August, according to the ISM. The Fed's benchmark rate stands at a 22-year high of roughly 5.4% after 11 hikes, beginning in March 2022. The central bank's rate increases have led to much higher borrowing costs for consumers and businesses across the economy. On the one hand, Fed officials, including Chair Jerome Powell, have stressed that inflation remains too far above their 2% target and that another rate hike might be needed to slow it to that level. At the same time, several Fed policymakers have underscored that they want to be careful not to raise borrowing rates so much as to trigger a deep recession. The September hiring report comes at a time when the Fed is scrutinizing every piece of incoming economic data to decide whether it needs to raise its benchmark rate once more this year, or instead just leave it elevated well into 2024. Job growth has remained resilient for most of the past 2.5 years, even after high inflation flared and the Fed jacked up interest rates at a never-before fastest pace in 4 decades. Yet additional threats to the economy have emerged in recent weeks, including much higher long-term interest rates, rising energy prices, the resumption of student loan payments, widening labor strikes, and the ongoing threat of a government shutdown. The job market has been so strong for so long that a slowdown, as long as it remains gradual, would still keep it at healthy levels. The number of Americans seeking unemployment benefits, which tends to track the pace of layoffs, has remained persistently low. Many companies are reluctant to shed workers after having found it difficult to staff up again after the 2020 pandemic recession ended with a quick and robust recovery. The unemployment rate in the U.S. was at 3.8% in September of 2023, remaining unchanged from the February 2022 high from the previous month and slightly above market expectations of 3.7%. Still, the result consolidated evidence that the labor market remains tight on historical standards, adding leeway for the Federal Reserve to leave borrowing costs at restrictive levels for a prolonged period. The number of unemployed individuals was essentially unchanged at 6.36 million people. The so-called U6 unemployment rate, which also includes people who are willing to work but have given up hope of searching, and those working part-time because they cannot find full-time employment, edged lower to 7% after touching a 15-month high of 7.1% in August. In the meantime, the labor force participation rate was also unchanged at 62.8%, the highest since February 2020. The United States has experienced 11 recessions. From the 1948 post-war period, U.S. has struggled in terms of unemployment. The federal government has tried innumerable methods over decades to turn around recessions and push back unemployment, including stimulus spending and tax cuts. The oil embargoes of the early 1970s triggered an economic slump that lasted until the mid-1980s. Inflation rose and the economy's growth began to slow, a trend known as stagflation. The country entered a time when the economy was in serious trouble, Cecilia said. President Richard M. Nixon sought to bring down inflation by implementing price and wage controls. When Jimmy Carter became president in 1976, he began policies of deregulating the oil and gas industries. Unemployment, inflation, and interest rates shot up during Carter's last year in office. Those factors paved the way for Ronald Reagan to win the presidency in 1980. The collapse of the internet bubble and the September 11 attacks pushed the country into recession shortly after George W. Bush took office. In an effort to spur growth, Bush and Congress passed an economic act that cut taxes and gave everyone who filed a tax return in 2000 a rebate check. The economy hummed along, with the housing market enjoying record prices. But then housing prices began to decline, and the current financial crisis took hold, triggered by the fall of the investment company Lehman Brothers. Shortly after Barack Obama took office, Congress passed a nearly $800 billion stimulus designed to jumpstart the economy and lower unemployment. However, high energy prices and the overhang of the housing market have brought economic growth to a virtual halt. The figures were being closely watched for signals of the next move by Federal Reserve policymakers who have tried to rein in both wages and prices by pulling up interest rates. Because further rate increases can negatively affect stock and bond prices, robust job numbers often cause a sell-off among investors. The market reaction was generally positive on Friday, largely because the report showed an economy still growing while wage growth moderates, leading many to believe the Fed will keep rates steady. Average hourly earnings for workers rose as almost 3% by September 2022. While solid, the increase was smaller than anticipated, and the one-year pace was the slowest since March 2020. I don't think the headline jobs number necessarily means an inflationary impulse because average hourly earnings gains are going down, said David Cervantes, the founder of Pembroke Capital Management, an asset management firm. For those worried about the extent to which higher wages may still be contributing to inflation, he said, this month's number should provide some ease. Biden administration officials celebrated the report as unambiguously positive. Simply put, good news is good news, full stop, said Jared Bernstein, chair of the White House Council of Economic Advisors. Every economy has its headwinds, but the Bidenomics job market has been a strong, persistent tailwind. The economy's staying power, more than 3 years into the recovery from COVID pandemic shutdowns, can be seen in many ways. Inflation-adjusted economic growth accelerated over the summer as overall price increases slowed to a third of their pace a year ago. Spending has eased from the breakneck speed of 2021, yet demand for travel, hospitality, and event tickets remains high. Jobless claims are hovering at February 2020 lows. Thanks to the U.S. Gov, the working class has become optimistic and is looking forward to more exciting opportunities and openings in the economy. With more videos and content, we will be back. Here is a reminder to like the video if it was informative and added some value for you. Please comment on your views, subscribe to our channel, and wait for more exciting videos.